Hello everyone, welcome back to Banking and Finance with Chitrak. Today we'll be continuing with the second part of the KYC specific requirements chapter. So let's begin. We will start with judicial persons, risk and due diligences. So in the last part we discussed various types of judicial persons like the partnership firms or the trusts, or you have the associations, a body of individuals. Then we had companies like that. So firstly, why does money launderers and fraudsters use them? So globally, the judicial structures are used by money launderers and fraudsters. Why? Because it helps in keeping key individuals behind the cover. Also, the persons in front dealing with the bank or public or paid executives, and in several cases may not be aware of the actual activities, and shareholders, partners, authors or trustees could be benami or proxy. So basically, now, what type of transactions are routed through them? Basically, high degree of due diligence is required for these entities. Why? Because they transact hawala transactions. We discussed that in the last video about hawala transactions. They also does trade-based money laundering. There is fraudulent transactions, that is routing hacked RTGS or using forged instruments. Then they can claim fraud from government like the tax refunds, duty drawback or other government incentives. Then fraudulent collection from public, for example the multi-level marketing, or which is the pyramid scheme, or any fake investment scheme or fake job schemes. Well, fake job schemes is very known to the people of West Bengal. Anyway, there also is terrorism related activities like collection of the funds, undercover networking or covert communication links to overseas entities. So all these kinds of transaction can be routed through the judicial persons for the benefit of the money launderers. What are the peculiar risks of specific entities? For corporates and partnership firms that typically used for the hawala transactions or trade-based money laundering and various types of fraudulent activities. Associations and trusts are generally used for hawala transactions, and trusts are generally used for hawala transactions and terrorism related activities. Also, use of the trust for the terrorism related activities provides an effective cover, like a hospital or a religious activities or orphanage or old age homes. They use these as the front for laundering their ill gotten money. Now, what are the due diligence required? Basically, the due diligence is exercised to understand the nature of the business of the judicial persons, its ownership and the control structure of it. So basically, the aim is to determine and understand the business nature and the ownership or control structure. Then the purpose, like preventing unlawful use by assessing the money laundering, terrorist financing risks, and then mitigate them. So that's the purpose of the due diligence. What's the basic minimum things required? We need the name, legal form, senior management names, registered office location, principal place of business, and business activity of the judicial persons who is opening an account for their business in the bank. We also should be satisfied with the correctness of the information. So one should verify the place, the transactions and the documents minutely before opening such accounts. Also, reliance solely on customer declaration or supporting documents may be insufficient, especially for higher risks. Independent verification may be needed. Like I said, you should do independent verification of the businesses or the documents provided by the judicial person. Then the degree of diligence depends on the nature, value or volume of the transaction. For example, when a school have normal volume of transactions, then you might be not so concerned with the risks. But if you see a large volumes of transactions and the transactions in untimely or in from some unregistered places, then you will have some doubts. Also, the transaction must align with the entity's activity. Like I said earlier, if a trust is getting money from different accounts in small amounts, right, so then you will have a bit of doubt about the situation of the trust. Now we learn about the proprietary firms, which is the most prevalent form of small businesses enterprise owned by any individual. So any shops or any small companies you see where there is only one owner, the owner is called the proprietor of the business. The KYC is requirements are same as in the case of any individual, but there's an extra need for additional precautions due to the widespread abuse of frauds. For example, hacked RTGS, forged instruments, routing the tax refunds, duty drawback, government incentives, MLM type activity, fake investment scheme or fake job schemes. Also, there's a need for taking additional precautions. No legal requirements for creation of a proprietary firm and no restriction on the number of firms proprietor can have. This firm provides the most convenient cover for money launderers and fraudsters. So, as you know, there is no restriction on the number of firms a proprietor can have. A person can have an n number of stores in the name of a single proprietor. Also, there is no legal requirements for creation of the proprietary firm. If you get a trade certificate from the state government, then you don't need any other legal documents for starting a proprietorship firm. So it becomes a heaven for the money launderers to launder the money through these proprietary firms. RBI guidelines specify some additional documentary requirements. As I said, the trade finance, the business transactions, the ITR of the proprietary firm, you need to check all those things before accepting or opening any proprietary firm. Now, what are the documents and due diligences? Customer identification procedure for the proprietor as individual is to be followed. Additionally, 2 prescribed documents in the name of the firm must be taken as business activity proof. What are the documents? Like I said, a trade certificate and the ITR of the proprietor. If only one document is available and the bank is satisfied that a second proof isn't possible, then the requirement can be waived provided activity verification is done and the bank is satisfied about the firm's existence and activity from the stated place of business. Now, what are the prescribed activity proofs? The registration certificate in case of a registered concern, the certificate or license issued by municipal authorities under Shop and Establishment Act, like I said, the trade certificate, then the sales and income tax return, then you need the CST, GST or VAT certificate, then certificate or registration document issued by the GST or professional tax authorities. If it's a import-export firm, then the import-exporter code issued to the proprietary concern by the office of DGFT, which is the Directorate General of Foreign Trade. We also need the license or certificate of practice issued in the name of proprietary concern by a professional body incorporated under a statute. For example, if it's a CA firm, then you need the certificate of the CA before opening such accounts. Also, a complete income tax return in the name of the sole proprietor where the firm's income is reflected. You also need the utility bills like electricity, water or landline telephone bills in the name of the proprietor or firm. Now, what is client accounts opened by professional intermediaries? These are such accounts which are opened by professional intermediaries for their clients. These are used by the intermediaries for carrying out transactions for their clients to whom the funds actually belong. Now, different types of accounts in this category require different approaches. Accounts not opened for professional intermediaries who are unable to share their client particulars with the bank. So basically what happens is that sometimes some lawyers or financial advisors or accountants may open accounts on behalf of their client, but the professionals must provide the details of their clients with the bank. Without that, no accounts will be opened. Then specific beneficial owner. Now, if funds of a single client or specific clients are routed, individual beneficial owners must be identified. So all beneficial owners must be identified even if the funds are commingled. So basically, when the professional intermediaries open an account, if it's for a specific client, then also the individual beneficial owner, like who is the owner of that account, must be found or identified. And also if the funds are commingled, like for several clients the account is opened, then also all the beneficiaries for whom the account have been opened should be identified. Also, regulated entities can rely on the customer due diligence done regulated and supervised intermediary with adequate KYC systems. But the ultimate responsibility rests with the regulated entity. There is a concept of pooled accounts. Like mutual funds or pension funds need to maintain pooled accounts for conducting their business activity. What happens is that a regulated entity might open an account for a number of retiree employees. Their PF or pension amount is stored in that account, and that account is not named by a single person but a number of persons for their pension benefits. Also, these accounts can be opened in normal course and due diligence of the funds is carried out and it is verified that they have the required registration or approval. For intermediaries like stockbrokers use bank accounts for carrying out the regular transactions for their clients. Banks need to rely on the customer due diligence carried out by the intermediaries. Now, when you have opened a demat account, especially now in the online demat accounts, you have seen that intermediary, for example, Zerodha or Upstocks or ET Money or whatever, they do a KYC or video KYC of you, and then an account is opened on your behalf. Now, this account is actually with the other regulated entity, but the due diligence is basically carried out by the intermediary or the brokers. But the banks need to satisfy themselves that the intermediary is a regulated and supervised entity and has adequate systems in place to comply with the KYC. But like every time, the ultimate responsibility is with the bank for knowing the customers. Now we'll know about the trust, nominee or some fiduciary accounts. So basically fiduciary means someone who manages money or property for someone else. So basically some arrangements are there under which the customer who opens the account is just a fiduciary in capacity. That means he only manages the fund, but the fund actually belongs to someone else or a third party. So in such cases it's important to know the details of such arrangements, and these have similar arrangements like a trust as we discussed above. Again, these accounts have a potential high risk of being as a money laundering and terrorism financing because the fiduciary person doesn't know the sources of the income. So it becomes a high risk for the banks to open such accounts. Again, to satisfy the customer due diligence, it's important to find the identity of the intermediaries, then identity of the person, like who is the real beneficiary or the fund provider or manager and for whom the fiduciary persons are acting. We also need to know the details of the nature of such arrangements, like the contracts they have and the need and purpose of the arrangement, like why the actual beneficiary cannot arrange such funds. It's important to know that. Now we'll know about the politically exposed persons or PEPs who resident outside of India. So basically, by FATF standards, the foreign PPs or politically exposed persons are individuals entrusted with prominent public functions by a foreign country, like the head of state or of government, senior politicians, senior government, judicial and military officials, senior executives of state corporate, and important political party officials. Again, earlier FATF recommendations required additional diligence for domestic PEPs. Revised recommendations contain similar approach in respect of domestic PEPs where high-risk business relations carried out. It's also recommended similar approach be applied for PEPs that are close associates of such family members. So this will be like a similar approach for foreign PEPs. Earlier, only the diligence for domestic PEPs were given. Now, foreign PEPs diligence is all the close associates or the family members of the political persons should also be approached in a similar way. Now, the RBI guideline says politically exposed persons or PPs are individuals who are or have been entrusted with prominent public functions in a foreign country. Examples, like we said, head of the states of government, senior politicians, senior government or military officials, and senior executives of state-owned corporations and political party officials. So what are the approaches we should follow? First, the coverage. It's applicable to foreign PPs, their family members, close relatives, entities where they are beneficial owners, and prudential measure for several banks, including domestic PPs, are in the same procedure. How to identify? Apart from the identification of PAP, identification should be done at the time of onboarding of new customers when they are just opening the account of the bank, and also system should be in place to identify the existing customers becoming PEP. Let's suppose the bank has a customer and he becomes a foreign PEP, then a system should exist where you identify such persons. What are the due diligence? Sufficient information on the person, all available information in the public domain, verifying the identity, and seek information about the sources of fund. The authority to approve the decision to open an account for the PEP should be taken at a senior level, and also this should be clearly mentioned in the KYC policy of every individual banks. There should be an ongoing approach, like enhanced monitoring of such accounts and customer due diligence should be going on an ongoing basis. Now, non-face-to-face customers. So customers who open accounts without visiting the branch or meeting the officials are non-face-to-face customers. Wherever accounts are opened for customers without the need to visit the bank branch, specific measures need to be taken to mitigate the higher risks. What kind of steps? Like the certification of all documents to be insisted, additional documents, the first payment if considered necessary to be through the customer's account with another bank which has similar KYC standard, and for cross-border customers, certification of documents, introduction by a third party which is regulated and supervised entity with adequate KYC systems in place. So basically, accounts which are opened using OTP-based eKYC. An OTP through the KYC is used for opening such accounts. And what are the conditions? Customer consent. A specific consent from the customers for authentication of the OTP should be taken. Balance ceiling for all the deposit accounts, total balance should not exceed 1 lakh. If crossing the limit, then the operation of the account should be stopped until a customer due diligence is completed. Credit ceiling, the total credits in the financial year in all deposit accounts should not exceed 2 lakh. Then loans, only term loans can be sanctioned up to 60,000 in a year. So what's the tenure of such accounts? So these eKYC OTP based accounts are allowed for only a year. Then the OVD as per norms is to be carried out. Aadhaar details are used for this purpose and the entire process including fresh OTP is to be followed. No CDD. If the CDD procedure is not completed, the deposit account should be closed immediately. For borrowed accounts, no debit should be allowed. Now, a declaration must be obtained that no other account has been opened or will be opened using the OTP-based KYC non-face-to-face mode with any other regulated entity. So, only one account is allowed to be opened using this process. There is CKYC intimation. What is that? While uploading the KYC information to CKYC, the regulated entities must clearly indicate that such accounts are being opened using OTP-based eKYC, and other regulated entities will not open any accounts based on such KYC information. Monitoring the system, the regulated entity must have a strict monitoring procedure, including systems to generate alerts in case of non-compliance or violation to ensure compliance with the above mentioned conditions. So, for example, if a transaction or high value transaction is done through the account, then a notification must be given to the regulated entity so that they are aware that such fraudulent activity are being going on using this OTP based KYC account. Now, in cases of joint accounts, or if a add-on is included in a card, the KYC procedures needs to be carried out for each joint individual account holder and or for each add-on card holder in case of credit cards. Now, we'll know about the foreign student accounts. So, foreign students coming to India for study will need an account for receiving the funds from their home country, right? Now, to meet the expenses, a non-resident ordinary account is opened. A most cautious approach is to be followed for potential money laundering and terrorism financing risks of such accounts, because you don't know the person who is coming here to study. He might be a normal student or might be a terrorist. So, you should have a minute approach to detect the fraud going on in this account if there is any. Now, what are the documents needed? You need his or her passport with the visa and immigration endorsement bearing the proof that the identity and address of the home country is correct. Then a photograph is obviously needed. Also, a letter of offering admission from the educational institute where he or she is studying in India. Then you also need a local address which should be obtained within 30 days of opening the account, and you should verify it. What's the restriction? During the 30 days pending verification of address, the foreign inward remittance must not exceed 1000 USD dollars and a monthly withdrawal of maximum 50,000 rupees is allowed. There are some applicable conditions for NRO accounts which you can see in the different types of accounts or foreign accounts of India. You must note that students with Pakistan or Bangladesh nationality needs prior approval from the RBI to open such accounts. Now, FPIs or foreign portfolio investors. So, these investors need to be registered with SEBI. FPIs registered with SEBI are subjected to KYC process by a SEBI registered custodian or intermediary who can open the account under the PIS or portfolio investment scheme. So, banks can rely on KYC verification by SEBI registered custodians or intermediary as per the third party reliance under the PMLR. For the small accounts, basically the purpose of small accounts is for financial inclusion and for providing the hardship to persons not having an officially valid document. So, a facility of small account is created for them. This account is an interim relief, and the procedure of this account is prescribed under the prevention of money laundering rules and must be followed diligently. A small amount means a savings account which is opened in terms of the sub rule 5 of the PML rules 2005. What are the features of such accounts? It's a savings account and it should not have more than 1 lakh credit in a year. The withdrawal should not be more than 10,000 in a month. Also, not more than 50,000 should be there as a balance at any time. There are some other restrictions like no foreign inward remittance is allowed in such small account. What's the procedure for opening such accounts? Only CBS linked branches are eligible for opening such small accounts, and where restrictions on the account can be monitored before allowing transaction should be permitted. What are the eligible customers? Any person who do not have any of the OVDs as prescribed by RBI and has no other bank accounts. What are the documents required? A self-attested photograph, signature or thumbprint, and the account opening form. The designated officer can verify that the person opening the account has signed or affixed thumbprint in his or her presence. What's the procedure for operation? It's valid for 12 months and another 12 months can be provided if the customer shows or gives a proof that he has applied for an officially valid document within the initial 12-month period. If no OVD is provided by the customer within the 24 months, then the account should be reviewed with relaxation norms and operations in the account should be stopped. Now, if there is no balance in the account, it should be closed. Such formulation must be incorporated in the KYC policy of each individual banks. SHG or self-help group is also a initiative for financial inclusion like the small savings bank account. So what happens is that 10 or more than 10 women open a savings bank account and save some money in that account. Then after a certain period of time, they can take loans using that savings bank account. So relaxation is given in KYC processes of opening such SHG accounts. So initiative should not be hampered. Also, there is no need to undertake CDD of all the members of a SHG for opening the savings bank account. Only CDD of all the members is required at the time of credit linkage. So basically, when they are opening the savings account, only the top 3 members, that is the president, vice president and the treasurer, only their CDD or due diligence is enough for opening the savings account. But if they are taking loan using that SHG account, then and only then the customer due diligence of all the members of the group should be done. Now, new technology and card products. Use of new technology based products is increasing at a fast rate. These products have some distinctive money laundering risks like anonymity provided by net banking. So, adequate measures for reducing such risks should be taken by banks. This could be closer monitoring of transactions, seeking more specific information about the customer occupation and others. Presently, variety of card-based products like debit cards, credit cards and variety of store value cards are present. These products can be used for purchase of goods and services, withdrawal of cash and remittances. Appropriate KYC AML procedures needed to be followed for these products. Also, KYC requirements apply to the holders of add-on cards and supplementary cards too. And wherever direct sales agents or DSAs are engaged for selling cards, they should also be subjected to due diligence and KYC procedures. So, this is it for today. Now, we'll complete this chapter in the next video. It's a very big chapter and a lot of informations are given here and it's very important for the KYC part of the exam. So, I hope you have liked it. Subscribe this channel and share it with your friends, and if you have any query, do comment below. Thank you. All the best.